Hello and welcome to Big Deal. I'm Nisha Poddar. Now on Big Deal today, we are joined by the industry players in the private credit space, which is, remember, gaining momentum with more demand for the structured, differentiated loan as more and more players enter this space to solve for the gap left by the banks and the NBFCs. Let me welcome on the show right here in the studio Kapil Singhal of True North, Amit Agrawal of Edelweiss Alternatives, and Piyush Gupta of Investec. Gentlemen, so good to have you in our studios in CNBC-TV18. Welcome to CNBC-TV18. Now, Piyush, starting with first, why this huge influx of many players coming into the space, and how's the demand scenario looking?
So, I think, Nisha, globally, private credit asset class after the global financial crisis really took off because of heavier regulation of banks, stricter capital requirements for mid-market lending, etc. India has been no exception, and particularly after 2013-14, when the NPAs issues surfaced. It's NBFCs which stepped in to take away that market share across wholesale, retail, etc. But after the IL&FS-related events in 2018, I think the business model of wholesale lending NBFCs, which was heavily dependent on, taking leverage on the books and running some ALM gaps, etc. So, because of which, the wholesale NBFCs have had to take a backseat and give away space. Credit funds, credit mutual funds have also are down to like 1/3 of the AUM they used to have until 2018. So there is that space vacated by banks, NBFCs, and credit funds on one side. Secondly, the corporate bond market in India hasn't really evolved to the extent it is in some of the more developed markets, or even some of the more emerging, some of the peer emerging markets.
Right.
So it's still very restricted below AA rated corporates, etc. And the third dimension is the regulatory restrictions. So banks, for example, in India are not allowed to finance domestic mergers, acquisitions, or stake buyouts, etc. So the demand drivers include, non-bank end use, for which borrowers cannot go to banks, or for low-rated corporates who have viable businesses, have bankable, credit profiles, but don't have access to corporate bond markets, or are really not getting proper solutions from banks and other traditional capital providers.
That's right.
And lastly, I would say, banks, or for that matter, NBFCs, or any traditional form of debt capital providers, or even corporate bonds, compared to that, non-standardized, more flexible, bespoke, solution type of debt financing, that's typically,
so more tailor-made, more flexible, more to solve the purpose, and mostly are short-term in nature as well, as I've seen, at least for this year into 2023, whatever deals have happened have been for a tenor of 2 to 6 years. So that's also one. But from what you said, a differentiated product and many aspects that we can delve further into. Kapil, you are in the midst of raising funds. Now, it's an AIF product, and where the investor is quite informed. They know the risks that they are taking. What is it that is interesting the investors, and what is the interest level coming in from there?
So I'll just first make a distinction, Nisha, that from an offshore perspective, I think we should speak both in terms of what is the offshore interest as well as domestic interest.
Sure.
Offshore interest will be subdued for some time because the MIFOR rates, the global rates have gone up by 400 basis points. And therefore, a typical well-rated company today, like a Blackstone company or a KKR company, will borrow today at 9-10% dollar. And what we are able to offer domestically, net of all fee carry expenses, is roughly the same number, maybe 100-150 basis points over. So for some time to come, offshore interest will be subdued from a tactical basis. People who will still invest in India on offshore basis will be more GP relationships, more long-term strategic relationships, so they will continue to come in India. But an immediate trading kind of trade-offs that, I want to earn a slightly higher returns and invest in India will be limited for some time. But as the rates cool off, and surely they will in a matter of maybe 2 years, 2.5 years, whatever time it takes, the offshore interest will come back again.
Right.
Domestic market, on the other hand, has been extremely buoyant in the last 2 years.
Yes.
And especially coming off the regulation changes that happened in the early part of this year. Significant one of them being the tax changes for mutual funds, tax changes for market-linked debentures. It has become a very, very attractive asset class for domestic, informed, institutionalized investors, and working with a set of managers like, two of my counterparts here, our platforms.
Yes.
So they feel comfortable working with us, and there is a huge amount of interest.
So it's a domestic pool of capital also for infusing the growth capital in our own companies, which has been one of the prime aspects of IBCA's efforts.
Absolutely. That has what has been driving the private credit growth in the last maybe 1.5 years.
No, domestic pool of capital and getting advantage over the foreign investors for a change, because the spreads are not now in their favor. So that can tilt any moment, but that could be one of the very big reasons why it makes for a lucrative
There is a 500 to 600 basis points delta today in terms of what, let's say, three of us are able to offer compared to a typical debt mutual fund product.
Yes, but that's cyclical, Kapil. At the moment, it's lucrative, but that can change.
Not really. I mean, it's not. It's a matter of debate. I wouldn't want to, drag this conversation into that direction. But I would say that it's a reasonably stable delta.
Yes.
Private markets are reasonably inelastic when it comes to repo rates.
Yes.
They continue to play within 100, 200 basis points. They don't change dramatically.
Right. All right. So that point made. So, Amit, your institution has been in this business for so many years. The kind of products, the differentiated products, and right now, have they evolved according to the needs of the industry? Give us a sense of the products and the demand coming in.
So I think as Edelweiss Alternatives, we have been in it for 12 years, and we have seen the products evolve over a period of time.
Yes.
What started as maybe $100 million fund, today we have more than $1 billion funds in each of these categories. And the categories are fairly simple. They have to cover the entire credit risk spectrum. What private credit funds offer is actually superior risk-adjusted return. So when you adjust for the risk that these funds are taking, that is slightly superior return out there. The products, if you think, are mostly aligned around the return ranges.
Yes.
So the return ranges could be 14 to 16%, could be 16 to 20%, could be 20% plus returns.
Yes.
So the products, whether you call it performing credit, whether you call it super performing credit, real estate credit, or special situations credit, all the products have takers. The key thing, and which is what Kapil and I like to add to Kapil's statement, I think the domestic clients, and you also said, are quite savvy. They quite understand. They are going after established platforms with established risk mitigation practices and people who have given performance and track record. So if you have said that you will be 14 to 16% return and you are 15, they will come in your onward fund.
Right.
So performing credits typically are anywhere between 14 to 17% return. You could have more bespoke solution called structure credit funds or maybe real estate funds, which could be in the range of 17 to 20%. And you could have special situations fund offering more than 20%. But the clients look at the risk, what I should say, mitigation when they invest in a platform. And what, like for example, Edelweiss has 60 investment professionals on the private credit side, but we have around 100 other people around operations and risk management. So people are looking at who is the asset manager who has delivered. So if somebody has said 14 to 16 and he delivers, he gets money very well in his next fund. Somebody has said 20% plus and he delivers 17%, he does not get the next chunk of money. So they are quite aware of what a product manager is speaking, and they play across the spectrum depending on their risk appetite. So a client might want some money in the 14% category. Some client may say, okay, this is my high risk capital, I want only 20% plus return. And private credit as a part, so India does around 200 lakh crores of credit. The book currently is 200 lakh crore order of magnitude. Private credit is hardly 1.2 lakh crores. Which is
and
like 0.6% of the total credit is sitting in private credit.
So therefore, a huge headroom of growth that is probable also in the industry. So Piyush, of course, the pricing is mentioned. These are very high interest rates. right? Do you think the understanding from the company is good and evolved now at these rates? Of course, the NBFCs played a huge role in the middle, and the place that they have vacated also is in some way covered by the private credit space. Now, how easy or difficult is the conversion at these price points most of the times?
Well, so, just to give you a little bit of backdrop and context here. So there are, if we look at just pure mid-market corporate landscape in India, there are more than 3,000 companies. If I just take very narrow tramlines of $50 million to $500 million top line.
Yes, yes.
These are companies with operating, profitable track record history with at least 50 crore EBITDA. If I stretch it, the tramlines to $1 billion top line, it gets bigger and bigger. There's about domestic M&A of $60 billion, give or take, every year happening, for the last 4 years on an average. The mid-market part of it, the debt financing part of it would throw up another, 20-odd thousand crore of financing opportunity every year. There's stake buyout opportunity. There's $7 billion of private equity sponsor exit happening every year on average for the last 4 years through private markets.
Right.
Some of which will require debt financing. So I think just within the performing credit space, there's a good 40-50,000 crore per annum of opportunity, which is not serviceable by corporate bond market or banks, or for that matter, a lot of NBFCs.
Yes.
And therefore, the reason why the pricing is what it is.
Yes. All right. So the risk assessment is something that we will talk about. I want to understand.
I would like to also add a small thing here.
Sure.
It's not purely debt pricing also at all points of time. Sometimes this is equity upside sharing. Sometimes this is sharing in the growth. Sometimes it is baseline, which is fixed at a certain lower level. And then you are making more returns if the company's EBITDA grows.
Yes.
So these are not specifically, if you think of it in terms of, it is participation in growth, which otherwise would not have happened if that money was not available.
So we know of these products. Of course, one of the big private equity, foreign private equity funds had dealt with this. The mezzanine lending was being used as a cautionary thing, but then it did burn its fingers in that particular product as well. So we'll talk more about the regulatory aspects, the tax aspects, as well as the risk assessment aspects of private credit right after this very short break on Big Deal. Stay tuned. Yeah.
So that's all said. 50
Yeah.
lakh crore is not small.
Yeah.
We are only 1.2.
Welcome back. You're watching Big Deal and we are discussing the space of private credit. So Kapil, we were discussing what this product brings to the table, but the risk assessment part of it, because you're solving for a particular purpose and the company needs a short-term finance for a particular cause. How is the risk assessment done, given that the interest rates on this are also on the higher side?
So the way we think about risk, Nisha, is that there are 3 or 4 categories, as Amit elaborated on private credit itself.
Right.
Private credit is not one composite category. So performing credit, the risk management is slightly different.
Yes.
On distress, the risk management is very different. Venture debt is extremely different.
Yes.
So I don't think we'll have time enough to discuss risk assessment in all of them.
Yes.
But what I can do is I can talk about the performing credit risk assessment and the way we think about this category.
The basic principles and
the basic principle in India is there is 2 lacunas or 2 shortcomings of India today. And the sooner the fund manager recognizes those 2 shortcomings.
Right.
Number 1 shortcoming is legal systems are evolving.
Yes.
IBC has been set in place, but it has miles to go before it will have a real teeth.
Yes.
So if you understand this, that collateral enforcement works, but works only in certain situations.
Yes.
Then you will build a portfolio in a certain way. Number 1. Second is governance standards, reporting, accounting, related party transactions, middle market eco landscape. How is that evolving? It is again improving as we go along. But is it at the right top-notch standards as you would find in a developed world? It's not there. If these 2 lacunas are recognized, then you start to build a risk management strategy for Indian private credit, performing credit in a very simple way. The way, at least at True North, we think about risk management is risk management happens at 2 levels. One is individual deal picking. Second is, what are you creating the constructing the portfolio for your investor?
All right. So this, you've talked about investment. What about exit opportunities and recovery?
So I'm saying when you talk about a deal, deal has choosing the right company, choosing the right structure, choosing the right exit strategy, building a covenant and a collateral structure around it, which most people do, all of us do as an industry. But obviously at some point in time, you could go wrong.
Right.
It's a 16, 17% product. It's a 14 to 16 to 18% product. What are your risk mitigants? The way we think about risk mitigant is obviously you do the work, which is what I call as plan A. Good company, good promoter.
Yes, yes.
Then you build a second layer of protection by saying that I will amortize quickly, I'll keep the tenor short, collect coupons, reduce my exposure during the tenor.
Right.
Third is collateral.
Yes.
So this happens at the deal level, collateral, governance, protection.
Yes, yes. Like
After
any lending.
Yeah, like any other lending.
Yes.
What people forget at some point of time is these are high cost borrowings, things can go wrong, these are middle market landscape.
Yes.
Keep the position size small.
Yes.
Keep it under 5 to 7. Do more deals, do shorter tenor deals, create a portfolio which is a very different characteristic when it comes to
and not concentrating on one client can be one.
Nisha, this strategy is not replicatable to a distressed desk, it's not replicable to other classes of strategy, and it could be variant to Amit's thinking, it could be variant to the way Piyush thinks. This is how we think in performing credit.
But I think I would like to add, since you said about exit, I think what has been heartening in India is that private credit space has seen significant exits.
Yes.
All the people here who are sitting have seen good exits in the portfolio.
Yes.
I can give out our numbers broadly. We invested 21,000 crores over the last 5 years.
Yes.
And our cash realizations are more than 23,000 crores. So I think what IBC has done has brought in about a credit culture where the promoters do not want to lose their companies.
Yes.
And that is also fanning some amount of interest from the offshore investors into the country. Because prior to 5 years, today private credit deploys, in my view, anywhere between 30 to 35,000 crore annually. This number was not even 3,000 crore 6-7 years back on an annual basis. So I think we have come a long way and we have a way to go. But I think we are on the right path. That's what I think.
That's right. So Piyush, of course you can comment on this aspect as well. But I want to understand, being an AIF product under SEBI's regulation, AIFs have also gone through their whole, evolution of regulatory changes. How are we stacked up now, and how have changes really impacted the course of this particular space?
So look, on the regulatory side, I would say we are still evolving. It is still, the AIF industry in India is still in formative years compared to what it is in the developed markets.
Yes.
And I think over the particularly last 15 months or so, there's a lot of wood that the regulators have been chopping in terms of putting in a very comprehensive framework, a lot of housekeeping issues being fixed, etc., to ultimately lay a strong foundation for this asset class to really grow. So I think, be it compliance obligations, related party transactions, certification of an investment team, dematerialization of units, valuation, there are various areas in which SEBI has been coming out with a lot of regulatory fine-tuning.
Yes.
And which is all in the direction of making it more robust framework.
Right.
Having said that, I think there are some areas where, it's under regulatory consideration, and I think in the months to come we expect clarity, and that would definitely be the new enablers.
All right. So regulations are still evolving. That's one thing to watch out for.
Nisha,
Finally, 30 seconds, Kapil. How do you see this now growing, and also lessons from the past? Because some of the investors have burned their fingers in the past, and there are several lessons.
First thing we must understand, Nisha, is that the crop of current asset managers which are there today are all coming out of very good pedigree, track record. They are not sitting in levered vehicles. They don't have compulsions. Their carry compensation is aligned to the outcomes of the fund. It's a very different ecosystem than compared to what happened in the past.
Right.
Nisha, people don't understand this. What happened in the past happened in the books of a levered and a rated NBFC, where compulsions of doing a certain things are very different.
Yes.
Tell me one credit fund which has gone wrong, other than the real estate as a category, which has gone wrong, which was in the AIF format.
Right.
So there's a lot of
alignment
happening.
Yes.
Because what went wrong was in an NBFC format, which was levered, rated, and regulated.
As long as we learn from
a lot
the
of
past,
lessons
but
have
it's
been
a
learned.
differentiated product, and one of the key aspects in lending for the growth capital for the companies, and is set to grow, and therefore the demand coming in and also the investor interest
And
coming
by the way,
in.
it's an
Yes.
other important figure from the regulatory aspect. He covered everything. There were 8 consulting papers that came out from February to May. 8 consulting papers by SEBI.
Right.
So SEBI is in overdrive, and all of us, we are very happy with the way regulations are shaping up.
All right.
So it's not, we have miles to go. We have already covered a lot of ground as far as regulations
All right,
are
so the
concerned.
space evolving and it's getting bigger, and it's
getting
important
regulated.
to keep an eye on it.
Yeah,
Thank you so
getting-
much, Kapil, Amit, as well as Piyush,
Thank you.
for this very interesting discussion. With that, it's a wrap on this edition of Big Deal. Keep it with CNBC TV 18.